come on. You can do better than that. Yee-haw! Much better. So some of you know I was born and raised in Taiwan. The other day I asked my husband, what does a Chinese cowgirl say after yee-haw? And he said, 恭喜发财. So I told him, hey, saddle up, buckaroo. Let's ride off to the 18th client appreciation event.
Ladies and gentlemen, welcome back to the stage, your attorney and our favorite cowgirl from Toy Story, Kimberly Lee Ha!
Welcome to the 18th Client Appreciation Event. Now let's do it the right way this time. 恭喜发财. Can you say it with me? 恭喜发财. For those of you who have joined us for the first time, welcome. And for the rest of you who attend this event every single year, welcome back. And you probably know 恭喜发财 does not mean Happy New Year. It means congratulations, hope you get rich. But I want to tell you, richness is not just in money. We want to help you to look for the richness in your life. That's what we will focus today. You may not remember this, but last 12 years has passed quickly. And the last time we had a client appreciation event for the Year of the Horse was 12 years ago. Do you recognize some of you on the screen? I see you, all on the screen. Fast forward, we're at, again, Year of the Horse. Chinese lunar calendar cycles every 12 years, and each year is represented by a different animal. Can you guess what year this is? Year of the Horse. But there are also 5 different elements: water, wood, fire, earth, and metal. This year is the year of fire. So you can see every 12 years plus every 5 elements, this is a year of the fire horse. The next time we'll have another fire horse will be in 60 years. I don't know about you, but I probably won't be here. So enjoy this fire horse of 2026. It represents focused movement, disciplined momentum, and personal power. If you were born in any of these years, you are a horse person. I know there are a few today that told me you were born in the year of the horse. And the horse traits are energetic, independent, confident, optimistic, charismatic, that's for sure, Robert. And the most important thing, adaptable and resilient. Some of the famous horse people you may know: Clint Eastwood, Elvis Presley, Nelson Mandela, and also Jack Nicholson. We have to eat lucky food during Chinese New Year. So you can look at the picture here. On the right-hand side is the noodles. The uncut noodles represents longevity. So you eat noodles for good luck. And you will see dumplings represents prosperity because it's shaped like an ingot, like you have seen over here for our decoration. We also serve fish. You may be wondering, why fish? Because the Chinese pronunciation for fish is yu. It's pronounced exactly the same as extra or abundance. So fish represents abundance. Finally, you have the peanuts and the oranges. Peanuts represents fertility and quiet prosperity. We have lots of peanut candy around for that reason. If you didn't take any of them, please grab some on your way out to have good luck this year. And of course, oranges is a color of gold. It brings good luck and prosperity. So make sure you enjoy these lucky food for the Chinese New Year. I'm Kimberly Lee. I'm your host today. I'm not a real cowgirl. I just play one on stage. We're going to be covering today 2026 tax updates, what has changed, and what actions and strategies that you can take. Also, planning priorities for 2026. Then we'll zoom out looking at the 5 dimensions of wealth. We'll end with questions and answer, and then, of course, our traditional red envelope raffle drawings. In front of each of you, you should have a folder. And this is important because on the top of the folder, you have today's agenda. And then under the folder, you have our client appreciation event. There are 2 QR codes. If you have a moment, now or later, we would appreciate you take a moment to post a review for us so other folks out there who are looking for a good attorney, a good law firm to help them can find us. If you open the folder, there's some important information we have printed out for you so you can take them home. There will not be a test at the end. On the left-hand side of your folder, there is a golden color sheet. This is the most important piece of paper in this folder, besides the IRS, numbers and tax quotes there. So the confidential information feedback form, this is your raffle ticket. So make sure you put down your name on the top. I would suggest doing it now. If you are married, to double your chances of winning, I would each fill out one. If you have moved since you're connected with our office last time, please update your address. We usually find out you have moved without telling us when we send out the invitation and they are returned back to us. Then we have to call you and find out where you've moved. So keep us posted so we can update the information. And then, of course, the rest of it in the middle, how do we do? You can fill that out at the end to make sure I do a good job first before you give me a grade. So 2026, what has changed? Well, the one big, beautiful bill was passed last year. And it's about 1,000 pages. And of course, I only have about 40 minutes this morning to go through everything. If I were to go through all the changes, we'll be here till Sunday, and you're going to miss Valentine's Day celebration. So we won't do that. What we would do is I went through to make sure I selected the portion I believe will most impact our clients, that will benefit you the most. Those are the portions that we will touch on today. So the One Big Beautiful Bill basically made major changes and made a lot of the provisions permanent in the prior law, which was the Tax Cut and Jobs Act of 2017. In July 4th of 2025, this law was passed. It's basically create a framework going forward what that tax law is going to be. So it's actually really good in that it creates certainty. You may remember every year before, we're trying to tell you what's about to expire, what's going to change, what may impact you, what action you have to take prior to the expiration. Guess what? It's now permanent. Well, until Congress changes it again. But at least we have a fewer last-minute emergencies or clients calling us, say, in December and say, I have 30 days. What do I need to do before December 31st? That is not going to be happening anytime soon, which is terrific. But the downside is that you now don't have Congress kicking your horse behind forward to say, you better go review and update your planning. This requires more proactive from you and to take action for your own benefit. So the big picture reset for the Tax Cut and Jobs Act framework is now pretty much permanent, with some of these short-term incentives that only run from 2025 to 2028. The risk has changed now from panic to make sure we get this done now in case we die, till now is, wait a minute, let's think this through, let's make some strategic decisions so we can benefit the most from the tax code that is available. So if you take a look at this, this is a chart. I know it's very small. That's why the copy of this is in your folder. It tells you which portions of the tax code under the OBA, the One Big Beautiful Bill, is going to be permanent and which portion is going to expire, and mostly they will be expired in 2028. So let's turn to the estate tax. Those of you who have attended this event for the last 18 years know I always start with income tax and end the tax updates with the estate tax. But this year, I'm flipping it the other way around because the new estate tax law is now $15 million per person and $30 million per married couple, which means if you're married, like this lovely couple out here in the front, Bill and Sharon, that if you have $30 million in your total net worth, how much estate tax would they owe? 0. You're good. So this new law, which is permanent, and it's tied to inflation, so you'll be higher in 2027, is going to cover 99.9% of the taxpayers. That's a good thing. For those of you who have assets north of the 30 million for married couple, 15 million for a single person, guess what? This is not changing. It's not expiring anytime soon either. So you better take action versus waiting until something else happens. So this is an opportunity to make sure we do a mental reset and reassess what our assets are. Now, for those of you who are thinking, Kimberly, I'm okay, I got $3 million, but I will never get to 50 million. I'm not gonna worry about it. You're absolutely correct. Because for majority of the taxpayer, the new issue is a different type of tax, and we'll go over that. So let's do a recap on the estate tax. So 15 million for single person, 30 million for married couple, okay? And also, this includes your lifetime gift tax credit. So if I have $15 million, I'm going to give it all to my son today. I don't have to pay a dime to the IRS for the gift tax. Now, you also have every year you have an annual gift tax exclusion. That's the amount you can give away to anyone you want without any tax consequences, without any reporting requirements. That amount has increased to $19,000 per year, per person for 2026. If you are married, you can combine the gift. You can write one check for $38,000 to your favorite son or favorite daughter or favorite friend. The only person you can write this check to is whom? Me. You're like, what did you say? Right, so you can do that for everybody, but if you are married, that check must come from a joint account, okay, or a joint trust account. If you write a $38,000 to combine the gift in your personal account to your son, you are required to file a 709 gift tax return with the IRS to report the other half the gift you didn't tell your wife about. Okay, so make sure you do it right so you don't incur additional administrative expenses by having to file the tax return. The good news is that so long as you're under that level, you are safe. But if you're over that threshold, the tax rate is at 40%. Having said that, California is a terrific state to die because we don't have a separate state estate tax. So some of you who are snowbirds understand that other states you may have separate state estate tax. So you want to make sure you talk to the attorney in that state to plan for that possible liability. Now, why are we doing the estate tax first? Because for most of us, we don't have to worry about the estate tax anymore. So the most important part is what? A personal income tax. This is your new estate tax, and it's happening every single year. So I'm going to spend some time on this to make sure you understand how these things work and what the strategies may be. So the income tax structure after the OBA is largely all locked. The 7 tax brackets remains, and the top rate stays at 37%. The lower bracket continues on, but not all the brackets are going to be tied to inflation. So they may not be indexed for inflation and adjusted every year. And this is the changes on the screen. I know it's kind of small, that from 25 to 26. So you can see there's a slight increase on the bracket level for the single person, for married couple filing jointly. Everything has adjusted slightly because they're indexed for inflation. By the way, sometimes you go to a cocktail party or go play golf with your buddies, and they complain about, oh yeah, California, I have a lot of money coming in, I'm paying, I'm at 32% tax bracket, okay? And they're complaining about it, so you assume they mean they're paying 32% on every dollar they make. That's not true at all. This is called the progressive tax. So if you look at this chart briefly, for the first $1 to $11,925, if you were single, you are paying 10%. That's it. You're not paying 32%. So everything is a progressive tax. So really the right question, if somebody complains to you at the cocktail party about their 32% tax bracket is, hey, what is your effective tax rate? That means that actually add everything together at different levels and then calculated the actual tax percentage they are paying. And typically is much lower than what they claim they are paying for. Let's look at now itemized versus standard deduction. Now remember, we just showed you this chart. This is like gravity. This is the law. We can't change it. This is what it is. But what we can do is to understand the rules of the game and how to utilize it and strategize for your benefits. So they're itemized versus standard deduction. So there are some changes to the base standard deduction. You will see there's slight change of $350 for a single person in 2026, and then slight change for the rest of the categories. Of course, you're probably filing 2025 tax returns right now, so that's going to be your standard deduction on the first row under 2025. you also have something called the additional standard deductions. If you are 65 or older, or you are legally blind, or you're both, you actually have additional deductions. So you can deduct an additional $2,000 for 2025 if you are single, over age of 65, or blind. So you can see in 2026, there's a slight increase, $50, $100, a slight increase for this additional deduction. For 2025 through 2028, only these years, there's a new senior bonus deduction. You probably heard a lot of complaints, in the news, and people who are not seniors complaining about the fact that why should seniors have additional deduction? We should have people with newborn babies with special deduction. So just ignore everything. It's all noise. This is what it is. And we're going to do, if you're 65 and older or legally blind, you're going to take advantage of this. So if you combine the standard deduction, the additional deduction, and also the special 2025 to 2028 extra senior deduction, this is the maximum combined deduction you could have in 2025. I thought this would be helpful to you because you're filing the 2025 tax return right now. So this chart is in your folder. So you don't have to take copious notes. You can, but the chart's in there for your reference. Now, let's now turn to itemized deductions. Remember, standard deduction means you don't have to keep track of anything. But itemized deductions means you have to track what you want to deduct. Okay? You got to have receipt, you got to have supporting documents if you're audited. So one is mortgage interest. The interest paid on your home loan is deductible, but only up to $750,000, unless you had a mortgage before the law change in 2027 and you are grandfathered into whatever the amount may be, say $1 million mortgage, you're grandfathered in. But since then, it's now capped at $750,000. SALT deduction. SALT stands for state and local tax deduction. It's now capped at $40,000. And charitable giving, okay, you can donate to 501c3 organizations. Those are deductible for itemized people. And finally, medical expenses, but it has to exceed 7.5% of your adjusted gross income to be able to be deductible. So now these are the rules. So knowing the rules, what should we do? It's like playing a chess game. The winners are the ones who are sitting in this room, paying attention, learning the strategies. Because the IRS is not going to tell you how to save money in your taxes. So SALT deduction, briefly, it was $10,000 cap, and the new cap until 2029 is $40,000. That's going to help you with your itemized deductions. The reason why it's important to know is this. This chart shows the information from the Internal Revenue Service. You will see 73% of the taxpayers take the standard deduction. Another 17% takes the standard deduction plus extra deductions. Only 10% of the taxpayers are actually itemizers, okay? So if you look at this, you say, wait a minute, it's a lot easier just to take the standard deduction. But I'm going to teach you some strategies to be able to overcome these default assumptions. So think of chocolate and vanilla. The standard deduction will be vanilla. The itemized deduction will be chocolate. You don't have to choose, I want to be vanilla and be vanilla forever, or I'm a chocolate person, I'll be chocolate forever. You can alternate and choose what you want to do. So the strategy is knowing what is chocolate and what is vanilla and when to use each. So the new rule under the OBA is that there is a new 0.5% floor for your charitable deduction. That means the first 1/2 of 1% of what you give to charity is no longer deductible. There's also a reduced benefit for people who are paying at 37% level is now capped at 35% for charitable deductions. And finally, and this is a good part, for people who are non-itemizers, remember the other 90% of people? You can now give money to charity without itemizing and be able to take the deduction. So those are the changes in the rule. So the strategy here is called bunching. So why is bunching? Bunching is just a fancy word to really group together your deductions. Because of the floor of the 0.5% adjusted gross income, you have to exceed that amount to deduct. Also, for high income earners, they're capping at 35%. So all these is going to make a difference. And the 90% of the people who are standard deduction filers, you can now give up to $1,000 to any 501c3 organization, or if you're married, $2,000 to any charitable organization and deduct that on your tax return. So this is really important because at 0.5%, we want to overcome that threshold. So this is how we're going to do it. The strategy, this is the action step, is you want to exceed the standard deduction in the bunching years. Those are the chocolate years. The chocolate years are when you have to keep receipts and making sure that you collect those amounts. And then the alternate years, you will take standard deduction. The vanilla years, you take the standard deduction. Okay? So if you alternate years, you'll be able to avoid the new limitation that is set. So I'm going to teach you some advanced deduction, okay, after the bunching, right? So in the past, I have shared with you the strategy called the donor advised fund. I know many of you who listen to me actually done it and opened the account at Fidelity, Schwab, Wells Fargo, wherever you have your financial accounts. How many of you raise your hand, you have a donor advised fund? Good, good, good. And the other day, one of our clients just told me, you know, you never told me about the donor advised fund. And I said, let me check your record. You've attended our client event for 12 straight years. I want to make sure you take notes this time. Now, donor advised fund is a phenomenal strategy. It's simple. You just go and open an account, just like an investment account or a bank account. You don't need me. It's free. You don't need your accountant. You just open the account. The cost is very low from Fidelity and Schwab. And we have somebody from Schwab here. Raise your hand, Izzy. The top dog over there. Right? We have donor advised fund. And how it works is this, that you can give money to a 501c3 organization, or you can give money to your own donor advised fund. So think of your donor advised fund as your own charitable bucket of money that you control when you give the money out. So you control the inflow when you give it into it. So you can utilize that for tax deduction purposes. And you control when it goes out and how much it goes out to whichever charities that you want. Isn't that fantastic? And while you're waiting, and the money is sitting in the middle in that bucket there, is mutual funds making more money for you to be able to give to different charities. It's a phenomenal strategy, and I really hope everybody will consider using it. Now, with the donor advised fund, now look at this chart here. So if we're doing this strategy session for 2025 and 2026, for example, you typically give $10,000 to charitable organizations a year, okay? So you will bunch 25, 26 into 1 year, and say you will put $18,000 to your donor advised fund. Remember, that's your own charitable bucket. You're keeping it in there. You control it. And you still want to give this charity $10,000. No problem. You give them $10,000 for 2025. And what happens to that bucket? Now you have $8,000 left. Fast forward. Now you're in the vanilla year. You have standard deduction. You want to give another $2,000 or $1,000 to a charity? Sure, you can do that. You want to give it to your charitable organization? Sure, you can do that. And then you skip a year. 2027 and 2028, that's your chocolate year. You will put $18,000, bunch 2 years in there, and then go to your donor advised fund, and then you control how much it goes out to the charitable organizations. Does that make sense? So remember, chocolate, vanilla, chocolate, vanilla. Now, the other strategy you want to consider is for those of you who have retirement accounts, large IRAs, because you work hard and put money away. And guess what happens when you get older? The IRS wants your money. They want you to take out the required minimum distribution. And once you take it out of your retirement account, you have to pay what? Ordinary income tax on that money. He said, darn, but I want to give to charity also. So instead of taking the money out of your required minimum distribution from your account, pay the income tax, then give to the charity, and take a tax deduction, you are much better off to use something called the qualified charitable distribution. That means you can give money directly from your retirement account to a 501c3 organization. Now, there are some requirements. One, you have to be 70 and a half or older to be able to utilize a qualified charitable distribution. The second thing is that there's a cap. This year is $111,000. If you give $10,000, no problem. You want to give $200,000? Only $111,000 is going to be qualified, is capped. And this will directly reduce your ordinary income, so you can use this in your vanilla years. Now, this is extra sprinkle on your chocolate years. You can also use medical expenses timing. Now, of course, we don't know when we're going to get sick. We don't know when we're going to need doctor's services. But if you have elective surgery, you have hearing aids, you get your dental work done, you can actually try to bunch them and time them together in 1 year. So you can exceed that 7.5% adjusted gross income level to be able to deduct your medical expenses. So timing it and some planning is going to help you to save more dollars from your taxes. Now let's turn to capital gains. Capital gains tax has not changed. This is the money that you will pay to the IRS if you have an asset, it appreciated, and you sell that asset and you make money. The capital gain tax level for federal is still 0%, 15%, and 20%. However, because the income tax brackets have changed, you will see there's a slight change as to what it falls under 0%, what falls under 15%, and what falls under 20%. If you have an income of, say, $45,000 and you're single, and you have an Apple stock that appreciated double over time, and you sell it, how much capital gains tax do you have to pay to the federal government? 0. They said, oh, Kimberly, come on. If I make $45,000, I probably will have to move to a cardboard box. So no, I make more money than $45,000, but I do have Apple stock that have doubled and tripled, or NVIDIA, those AI stocks. What do I do with those? Remember earlier we talked about you have the $19,000 per year per person you can gift to your family members and anyone you want? If you want to give $19,000 to your favorite grandson, instead of writing him a check for $19,000, you can actually give him $19,000 or times 2, $38,000 worth of the Apple stock. And because your grandson is still in college, he's working part-time, making $20,000 a year, he can sell the Apple stock and pay how much in federal income tax? 0. So shifting that tax liability to the generation that may have a lower personal income tax. Now, of course, there's short-term capital gains as well. If you don't hold the stock for 1 year or longer, it's going to be a short-term capital gains. Short-term capital gains is the same as ordinary income. We don't want that, right? So make sure you're not doing day trading unless you're very successful and be able to guess exactly when the market is going to go up or come down or go up again. I don't know about you. In my humble opinion, it's a losing battle. Right, Izzy? So let's look at California state income tax. Remember, you have the federal tax, you have capital gains, but what about state capital gains tax? For California, the state capital gains tax is exactly the same as ordinary income tax. I know it's very small, but this is just to give you an idea of what that state income tax would look like for a single person and for a married couple. Now let's turn to other updates that you may be interested. Proposition 19. Anybody remember what Prop 19 was? Quick refresher. Proposition 13 is that great, fantastic proposition that keeps all our property tax low at the level where we purchase the property. It can go up a maximum of 2% per year, but typically 1.5%. So you could have bought a home for $500,000. They would tax you based on the $500,000. Of course, post-COVID, all the houses have gone up in value. Now your house is worth $2 million. You say, I can't believe this. But guess what? Your property tax is still taxed at that $500,000 plus the 2% increase per year. Proposition 19 changed the fact that when you passed away, if you leave that house to your children or to your grandchildren, it used to be exempted. So they could have kept the family home and still pay the lower taxes. But Proposition 19 changed that. So now when they inherit the property, they will have to pay the $2 million property tax. And so it's not good. Therefore, they have been trying to undo the Proposition 19 for a long time. This is the third attempt they're trying, okay? And so far, they have collected just a little bit over 500,000 votes. I don't know if it's going to pass. I hope it does. It doesn't look like they're going to be able to collect enough votes, but if you have a moment, I would highly recommend you send in your signature. They need to collect these signatures to be able to collect by May 5th of 2026. So there's still some time to make sure that you can help to undo Proposition 19. Secure Act 2.0. Kimberly, you talked about this last year and the year before. I know. But I want to remind you because for 2025 retirement contribution, you still have time. So I want to remind you that if you are still working and you have earned income, you are able to contribute to your IRA based on these age groups, and your deadline is April 15th of 2026. So you still have an opportunity, bless you, to be able to take advantage of this. Now, we covered a lot of numbers today. And I know your head is swimming. And some of you probably were so bored, you decided to figure out the QR code and posting a review instead of listening to me. But I want to tell you that money is only one of the dimensions of the overall picture. I have been in practice for almost 27 years. And in all these years, helping thousands of families, what I have learned is that the families with the most wealth and most money, and the families that save the most dollars in their tax savings, are not necessarily the families who are the most secure and the most happy. Security is not about just money. It's about having strength in all different dimensions of your life. So you have the financial wealth, family wealth, intellectual wealth, social and spiritual wealth, and then finally, physical wealth. You want to have the holistic approach to prosperity and well-being. When I talked about getting rich, it's getting rich in life, not just in your pocketbook. So financial wealth. Let's be honest about this. Money is important because money buys you options. It buys you choices. It allows you to say yes to things that matter and to say no to the things that don't, and focus on what's important. And many of you have tremendous wealth because you worked hard, you sacrificed, you saved when others spent. You collected, you made good choices when others partied. You have achieved, you're good. But that's not enough. That's why we have estate planning, to make sure we continue to protect that wealth that you have built. But if you have the wealth, but you don't have the family wealth, it will fail. Your estate plan will fail because your family is not prepared. If there's disharmony, resentment, hatred, all that is going to break up the family. Estate planning, we cannot fix your family problems. Oftentimes, clients' family issues existed decades before we ever meet you. But what we can do is to prevent family conflict. So to do a good job for your family wealth, that means you leave everything to them with clarity, not chaos, communication, forgiveness, embracing each other. Life is too short. Intellectual wealth. Most of you are retired, but retirement doesn't mean you end everything. Retirement only ends work, not growth. The happiest retirees are the ones that continue to grow and learn and adapt to the world, which changes every single day, every single month, and every single year. And we'll never be able to stop until someday when we're not here anymore. Social and spiritual wealth. You want to make sure you have a sense of purpose, connection, and meaning. Your community, your faith, your focus, your charitable work, whatever that would be. We, as human beings, are not meant to do life alone. Now, I love this quote. The greatest rewards come when you give of yourself. It's about bettering the lives of others, being part of something bigger than yourself, and be able to make a positive difference in the world. Physical wealth. If you have everything else, but you don't have your health, nothing matters. Some of you know my grandfather, he was a retired doctor. When he was 80 years old, he had 3 strokes. He lived for the next 21 years with 24/7 care. And he died at 101. Yes, 21 years. So longevity without mobility is not wealth. By the way, all the money he saved and put away from decades of medical practice were all spent for his care. When you don't have the mobility, it's dependency. My mother, who just turned 88, she does yoga 3 times a week. She exercises. She goes to her church. She has a terrific group of friends. And she's happy and active and healthy. So physical health gives you mobility, independence, and dignity. I invited her to come here today, but she was just here for a couple months during the holidays, so she says hello to everyone. The picture in the middle, was her birthday celebration when she was here when she turned 88 years old. Okay, I'm a nerd. Exercise is not my love language. But yet, 3 times a week, 8 years, no excuses, I show up to go see this man, Robert Hatch, my trainer. So I can stay strong. Because strength is not about preference. It's about responsibility. I choose to be strong so I can show up for you and for my family and for my community. So of these 5 different dimensions, let me ask you 2 questions. Where are you strongest? And where could you invest more time in 2026? You don't have to say it out loud, but ask yourself. We saw the picture from 12 years ago when we had the last year of the horse. Time flies. If you want to do something, do it now. Don't wait until next year when you're here again and I tell you the same thing. You say, yeah, I really should do that. I know Kimberly told me about this, but I just, busy. I gotta wash my hair. I gotta do whatever. No excuses, okay? Make sure you take care of yourself, and also if your estate plan have not been reviewed in the last 3 years. Some of you haven't seen for 10 years. Some of you haven't seen since last week. If you haven't had your estate plan reviewed, now the law is permanent. It's a perfect opportunity for you to now review and update and strategically making good decisions that will have much longer shelf life to protect your family. So let's ride off to 2026 with clear intention and confidence. Thank you so much for being our clients. Okay, so now we're going to open up for questions and answer. I believe we have 2 microphones, is that correct? So Webb, raise your hand. And then who else has a microphone?
Test. Nick is in the back,
Okay,
I think.
great.
Yes. Cowboy Nick.
So raise your hand if you have a question. Remember, this is free legal advice. I see hands over there to the left.
We'll start with
there's a
Nick
hand
over there.
Yes.
We have a hand.
Kimberly over here.
Hello, good morning,
Good
Kimberly.
morning.
I have a very specific question regarding the SAFE Act 2. In my current trust, in my current documentation, the IRAs are going to the trust. I understand that Act 2 has changed significantly the taxation, and I would like to explain how it changed, please.
Absolutely. So the question is this. You have not updated your planning since the Secure Act 2.0 passed. I know that, okay? So remember, when we do the trust planning for you, we are afraid you don't listen to us. And sometimes you do something opposite of what I tell you. You want to make sure that you name, if you're married, and that's your intention, to name each other as your primary beneficiary for your retirement account, so they have something called the spousal election to roll the IRA to the surviving spouse. We also ask you, if you don't have any children or you have other objectives, you can name the trust as a contingent beneficiary. Within the trust itself, to avoid hitting when the asset hits the trust that will trigger immediate income tax consequences, we create something called the IRA conduit subtrust to make sure there's a see-through so we don't violate the IRS rules. Now, prior to Secure Act 2.0, If you leave it to the spouse, they can continue to take the required minimum distribution. If you leave it to any non-spouse beneficiary, children, your best friend, your sister, your brother, whomever, they can actually do a reset and stretch out based on their own life expectancy. So if you name your grandchild who is 20 years old as a beneficiary, they can then do a reset and stretch out that IRA from 20 until the grandson's life expectancy. Secure Act changed that completely. Now you have to take it out. If you're a non-spouse or eligible qualified beneficiary, you have to take it out within 10 years. So it requires a lot of income tax planning in that to make sure that how do we make some decisions within that time period to pay the least amount of income taxes. So for those of you who have not, you have retirement account, you have not updated your planning, it's important to make sure you come back for review.
I have a question over here.
Go ahead.
On the donor account, charitable donor account, and you put in 1 year a given substantial amount of money to mitigate your tax consequence. In that year, when you put it in, you used it all up, okay? Therefore, you needed to put more money back in to keep it alive, and particularly when they end up using it to offset RMDs, required minimum distributions, which increased your taxable amount. How often do you have to use your RMD thereafter, in your donor account, thereafter, and it's in there, a lot of money. The government says you must use some of it every year. What? How often do you have to use that account?
I want to make sure I understand your question. Are you asking, you put money into the donor advised fund, and your question is how often do you have to take the money out to the charities?
Yes.
Okay, never. Okay, you can continue on and you can name a successor advisor. Now, if this is a family foundation, there is a minimum it has to go out every year to the charitable organization. But if you have a donor advised fund and you put money in there, it grew and grew and grew,
yes,
and you decided to not give to charity for now,
yeah,
but you're leaving it as a legacy, so someday your son or daughter can be the donor advisor and then dole it out as their future steward for that money. You can do that. Izzy, can you confirm that? Correct. We have an official confirmation from Schwab.
Yeah. And my account is with Schwab, but
So you should connect with Izzy. He's the best, and he has a group of advisors that can help you.
Yeah, just one. Nick, you good over there?
I need you folks to raise your hand so I know where you are. Okay, you are.
Okay.
Thank you.
Nick, real quick, we have one quick question, which is a follow-up on the donor advised fund.
Are the funds in the donor advised account taxable?
The question is the money that you put into the donor advised fund taxable? The answer is no, but in addition to that, the money you put into the donor advised fund is income tax deductible. Yep, and then put it in, it's not taxable, you just let it grow, 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 you give it to whomever the charities you want.
Go ahead, Nick.
Yes, I have a
Go
question
ahead.
from Greg.
Hi, Greg.
Hi. Could you speak real briefly on the difference between I'm leaving my home or resources to my kids or grandkids and generational wealth? I mean, there's got to be some planning decisions why the Rockefellers are still rich and the Vanderbilts are broke.
So I want to make sure I understand your question. You said you want to know about generational planning and that why the Rockefellers are still
Rich and the Vanderbilts
rich,
broke. Yeah.
and then why the government is broke?
Vanderbilts. The Vanderbilts are broke.
Oh, okay. So remember, that's a great question because you probably have heard generations who are successful They've done studies on this, multiple studies. Wealth does not rarely pass beyond the third generation. It's usurped, okay? So it's really important. Part of the success of ultra high net worth families is that typically they only make distribution on the income level, and they preserve the principle to continue to generate wealth for the future generations. And they have to choose very carefully who is going to be in charge of that pot of money. And if you have multi-generational planning, your timeline is much longer. Typically, you want to find an institution that's going to be there forever, hopefully, to be able to make sure that your intentions are followed. The other thing is that California is not a good state because we have, it's called the rule against perpetuity. That means the trust cannot last forever. And part of the planning in all your trusts, we have a provision that allows you to change the jurisdiction. So if this is a multi-generational planning, typically the trustee is going to move that trust into a more favorable jurisdiction, such as South Dakota, that can last forever, or Delaware, where they can last forever and not in California. I hope that answered your question.
Kimberly, I have a question over here.
Help, please. I am over-prepared, thanks to our estate portfolio that you provided and the estate planning magazine you gave us last year. Yet my wife and I are totally unprepared for what to do if one of us dies suddenly. Shock renders logical action difficult. Can you prepare a short, simple 1 or 2 page, step-by-step action plan the survivor can pull out from our medical file and follow in that eventuality? Having such a guide would be really very much appreciated.
Absolutely, absolutely. Millie, are you in the room? Millie, are you in the room? Go ahead and capture that so we can make sure we do that. And just so you know, you may not have the opportunity to attend. Previously, some of you may have attended, we did a lot of workshops as to what happens when the first person passes away in a joint trust, also what happens when a family member passed away. All the items that you need to do, what to look for, the steps, and we're looking to make sure that we do it in a video format because we notice that when we tell you, it makes perfect sense when you're listening to me, and you go home with that piece of paper, and then nobody else can find it afterwards. So we want to make sure is that when we do these, it's called the trustee workshops, to bring your successor trustee, not just yourself and your spouse, but also who's going to be in charge after your incapacity or passing. Okay, great suggestion. We'll do that again. Any other question?
Nick?
We have about couple minutes left.
Yes, Kimberly, I have Laura Gurman. Yes.
Kimberly.
Hi.
Hi. If I were to donate, like last year, a large amount of, let's say, jewelry to a scholarship fund that's been appraised by a jewelry store, all legitimate, how much of that, it came out to a substantial amount that was auctioned off for a charity. Am I allowed to deduct that total amount on my taxes?
No. This is a more complicated question because depending on how much you pay for the jewelry, right? You pay $1,000 for the jewelry. You donate it to the charity. They sold it for $1 million. The question is, can I donate $1 million because they sold it for $1 million? The answer is no. Okay, so you want to make sure you check with your CPA, look at the appraised value versus what they sold for, so the CPA will be able to tell you exactly what you can deduct for that donation.
Okay, thank you.
Okay, you're welcome.
We do have 2 more questions on this side.
Thank you. I would
Go
like
ahead.
to gift part of my RMD to adult children. and I'm wondering what the tax consequences are to me and to them, and if, and I don't think it is, possible to just transfer the money amount from one, let's say, bank account to theirs, or is there paperwork or a lot more involved?
Okay, great. So the question is, you have the RMD you're supposed to take every year. You want to know, can you give your RMD to your children and how to transfer that money directly to them? No, you can't, because the RMD, unless your children are a charitable organization, which I assume they're not, you cannot use the qualified charitable distribution. So you will have to take the money out from your RMD, pay the income tax, then give it to your children. But then it's subject to that $19,000 per year limitation. But it's okay, the exemption is so high now, you can give them more if you want. But unfortunately, you have to pay income tax on that money first.
Go ahead, Nick.
Go ahead.
Question over here. Yes, Mr. Benson.
So I have two questions, actually. One is, you mentioned no tax on tips and no tax on overtime, but you didn't say anything about no tax on Social Security. Did that get eliminated from the bill?
It's actually, the question is about that Social Security is partially taxed. You're correct. So part of the Social Security is taxed. Now remember, part of the strategies that we show you to reduce your adjusted gross income, and for example, giving money directly from your retirement account to the charitable organization is going to lower your income, therefore lower your Social Security income as well as your Medicare premium. So talk to your CPA regarding exactly how that applies to you on Social Security.
Okay.
Now, you only allow one question, but I'll indulge you for your second question.
Well, this one was more important for me, actually. So Prop 19, you were mentioning that you wanted people to basically vote to eliminate that. But my understanding, which could be wrong, was that Prop 19 had more benefits than to eliminate it, being that you would keep your property tax at that Prop 19 value, the plus 2% per year, which you would lose if that went away. I don't know if it would, the property would be reassessed at current market value after that, but the second thing is then the property would be, if you put it into a trust, the beneficiaries receive the benefit of a step-up basis. And also, being able to move your current property tax to a new home, new primary residence is another benefit of having it low currently. So what do you say to those things?
So you're absolutely correct. By the way, that was about 3 questions in that embedded one question. I got you. So you're talking about is Proposition 13, which is the one that keeps our property taxes low. The Proposition 19 changed Proposition 58, which is called the parent-child exclusion. That took away that. They gave you something more like, hey, you can move your property tax basis if you are seniors from one county to the other and keep that property taxes low, which is good. What they're trying to undo on the Proposition 19 is only the bad parts of it. The portion that would be exempt, that would otherwise be exempt from a parent to child exclusion, which is formerly under Proposition 58, and also grandparent, grandchildren under Proposition 168. So those are the bad part they're trying to remove to undo Proposition 19, but keep the good part that allows you to move your current tax basis to a home that may be a higher value. Also, as far as step-up in tax basis, whether your property is under Proposition 13, Proposition 19 pass or undo, whatever it may be, whether it's in a trust or not, you will get a step-up in tax basis when you pass away. The trick here is for the married couple in this room, for our clients, we did community property planning so that when the first of you passed away, you actually achieved, it's called the double step-up in tax basis. I just had an issue this week while I was preparing for this. One of our clients, the husband passed away, and we're trying to get the double step-up in tax basis, not just for their home, but also for their investment account. And you can imagine, since last year, the stock market has gone up tremendously, so they had a lot of gain in there. But the advisor from Florida says, Only 50% because the wife is still alive. We have to explain to them, no, we did community property planning. They achieved 100% step up on all the assets. They said, we want an opinion letter from you citing IRS codes to make sure we're covered. So we had to do that this week to make sure they achieved that result. So you will not be hurt by undoing the current Proposition 19.
Kimberly,
All right.
we have one
last question, because
over
my
here.
timer says, Kimberly, your time is up. Go ahead.
Yeah, go right ahead.
I just wanted to find out if you have any good or bad ideas about prepaid funeral expenses and if any of them are tax deductible.
So first of all, I highly recommend prepaid funeral expenses, okay, prepaid plans. And I'll tell you, my parents, I encourage them to do the same thing. Please have prepaid plans. Please have prepaid plans. And they had plots, but no prepaid plans. And they said, look, we're still alive. Don't worry about it. I said, I know, but it's called planning. And of course, they don't listen to me. And some of you know my dad was perfectly healthy, but he got pneumonia, and he promptly passed away in 2 days. Completely unexpected. We're in the hospital. I had to fly back from Florida. I was attending a legal conference, and we're in the hospital, and mom's crying, everybody's in shock, no funeral plans. And the doctor says, well, we can only keep the body here for so long in the freezer. Would you please tell us where and how your dad's body will be picked up? So while we're in the hospital doing all this, I was calling around to make sure who's going to be pick up my dad's body, making funeral arrangements. I do not recommend putting that pressure on your loved ones. I highly recommend prepaid plans. Pick the flowers you want. Pick the song you want to play. Decide if you want a celebration of life or a big funeral or with ice sculptures. Whatever you want, you get to choose. It's a party you will not attend, but you can plan for it. And no, it's not tax deductible. However, if you're doing, it's called Medi-Cal planning, okay? That amount you pay is going to be removed from, it's called countable resources, but it's not going to be tax deductible on your income tax. Okay, great. Thank you so much. I know many of you have more questions. You know, we could be here all morning, but we're going to go to the raffle drawings. So let's take a look at your goldenrod sheets. Before you fold it up, please, if you would, look at the presentation and today's experience here. We would really appreciate you give me an honest feedback. Every year, I try to improve from the previous year. You may or may not notice this. The microphones are lower this year because previous years, we have feedback from our clients that the microphone was blocking the screen in certain angles. So this year we figured it out. Last night we were trying to figure it out how we can have the audio be comfortable for the folks in the back at the same time without blocking the screen for the folks in the front. So any feedback you have, good or bad, I really appreciate it. And by the way, I read every single one of them. Okay, so make sure that you provide the feedback for us. On the very bottom of it, it says, action I would like to request. If you want to work on your financial wealth, you want to schedule your estate planning checkup, please check that box. We'll reach out to you to schedule an appointment. Somebody just asked us that whether or not it's free. No, you're going to have to pay for legal services. Now, the review is going to be, we do charge a review fee. However, if you do update and we update your planning, typically we'll waive that review fee and we'll just credit it toward your planning costs. The second thing is you want to work on your health wealth, okay? Some of you remember last year? We offered our trainer to be able to do a free session for you, just to assess your mobility, your strength, what you need to do. Do you know how many of you took advantage of that? Not enough. Not enough. I know. Believe me, I understand. I have never, ever, at any time, want to go to the gym. And Robert knows that. I show up and say, oh, I don't know why I'm here. I'm paying for this. I know how to do this already. I'm not sure why I'm here, but I do it. Okay, so make sure you work on your health wealth. Now, if you want to do that, Robert, again, this year is willing to provide a complimentary session for you, free of charge. Okay, your commitment is to show up. So check a box there, and he'll text you or reach out to you. Now, if you want a new CPA, you want recommendation for a CPA, check a box will provide the recommendations for you, or a financial advisor. Check a box for a financial advisor. Then lastly, I have clients asking me everything from, do you have a good manicurist, to who does your hair, who cleans your house, who washes your car. I have really good people, by the way. Who's your doctor? Who's your dentist? So if you need any of those recommendations, put it down. If I have somebody I'll recommend, I'll provide that information to you. And once you fill this out, you need to fold it and take your time. Don't rush, because I want you to make sure you get me your feedback, okay? Fold it in half like this. I know this is not that complicated, but in prior years, we have people folding into a swan. Fold it in half, and then the other half. So it's a rectangular shape like this. And once you're ready, if you would, this side of the room, pass it toward the center. And then on this side of the room, if you would, also pass it toward the center. And those of you who are center stage, pass it to your right. Let's see if we can follow instructions.
We have our senior paralegal, Millie, collecting on that side, and our other paralegal, Maureen, in the cowgirl hat, collecting on this side.
So just pass it down. They'll pick it up, not to worry. And for those of you who are joining us the first time, we typically do a raffle of 8 gifts, because 8 is a lucky number in Chinese. Do you know why number 8 is lucky? 8 means prosperity, okay? So you will see Chinese people always want to buy houses with the number 8 in the street number. So this year we have 8 gifts to be raffled off. And in the bag, there's an envelope of $88 and a very special golden ingot, which is not actually gold but has chocolates in them. So Webb, you want to come on stage?
Ladies and gentlemen, one more time for your attorney and our favorite Chinese cowgirl, Kimberly Lee.
So we're going to be passing down the bags, right? So anybody still have your raffle ticket without being picked up? There's one over there. Nick, can you help? Want to make sure you don't lose your opportunity. Now, you do have to be present to win. Okay. I know one year, I think we were so excited, we pulled more from one bag than the other, and all the winners were on one side. So this year, we're going to focus to make sure we are fair to both sides.
The fact that all the winners were right next to the stage actually made it quite convenient.
So once we draw, okay, so two different bags. Okay, so Millie is going to be in charge of it so that we don't accidentally draw from a different bag. So Webb, you're going to be drawing. What do you want me to draw?
You draw.
Okay.
She'll draw that way I don't have to hear about it when we get home. Our first winner is Lori Taylor Hahn. Lori, congratulations.
Yay! Okay, Lori, raise your hand.
Lori just had her shoulder dislocated.
Right here. So I'm going to give it to you.
Congratulations.
Lori, raise your hand, Lori. She'll bring it to you. Congratulations.
Okay. Second bag.
This is the second bag.
Okay.
So this is the second bag. I want to make sure.
Our second winner is Dr. Clark Martin.
Yay! Congratulations. This is the winner.
Yeah, he would win twice.
All right. So once I give it to you, then put it on the counter,
Okay.
please. Okay. Who's the next lucky winner?
The winner of the third lucky bag is
Microphone.
Ronald Kokney. Ronald?
Yay! Congratulations.
Oh, of course.
Okay.
Oh, we have two more
Uh-oh.
to get into the loop. That was number 3, is that correct?
Correct.
That was number 4? No, thank you for having my back. Number 5 goes to Neil Williamson. Neil, are you here?
Where's Neil?
Neil may have left the bill. Neil, raise your hand.
Right here.
There you are. Nice to see you. Almost see you.
Congratulations. Is this the new one?
Hope you get rich. Sure, number 6. Okay. Number 5, Nancy McPike. Nancy?
Yay!
There you are.
Congratulations.
Let's mix them up. We're getting a lot of center.
Okay.
Number 6. How am I doing so far? She rolled her eyes. Wow, today is a good day for doctors. Dr. Robert Martin. Dr. Robert Martin, are you here? Oh, there you are.
Congratulations. Wow. Okay.
We are looking right into the light, so I apologize.
I want to make sure everybody knows that I am mixing them.
All right, number 6. No, number 7, my apology. For lucky bag number 7, Linda Bozigian. Linda, congratulations.
All right. Last one.
And this is it, folks. The last lucky bag goes to Webb Wyman. That's so weird. That's me. Sulan Lamb. Sulan? Oh, we got someone on the far right. Excellent.
Congratulations. All right.
Gonchi.
Congratulations. Now, as a surprise, I know we already had the 8 lucky winners because you folks are so undisciplined. Even though we offer you free session with Robert, you still didn't do it. I asked Robert if he would offer gift certificates of actual money to motivate you to actually show up. Okay? And he graciously agreed to provide 3 of $500 gift certificates for training sessions. I wish I could use it, but he won't let me use it. So here's Robert. Oh, 4. Oh my gosh. So this is $2,000 worth of gift certificates. Yes. And this is Robert, my trainer. Now you can probably tell why I show up, because I'm afraid. And this is Jacob. He is a PhD candidate for physical therapy and also a phenomenal trainer. So I train with both Robert and Jacob. So if you would, Millie, if you return back with those bags again, and it's actually perfect, we have 4, so we'll pull 2 from each. So Jacob, would you be so kind to pull the winner? Okay. Mary Case. Mary, are you here? Mary? Mary's not here? Okay, we pulled a new one. All right, better chance than the rest of you. It's okay.
Terry Shock.
Terry Shock, congratulations. Maureen, do you want to, oh, it's okay, Robert will bring it over here. Good. Okay. Let's draw the next winner, Jacob. Who is the next lucky person? Okay, if I can read your handwriting, then you don't win. No, I'm just kidding. Christine Rogerson? Okay, no problem. Okay, Robert's going to pick this time.
Deborah Knox.
Deborah Knox. Now, don't waste it. You got to show up, okay? No excuses. I'm going to see you there. Okay, the next winner.
Ron Otta. I don't know about this. Okay, draw one more. Please make sure it's legible. You can't do that one.
Oh, that's you. Oh, no. Robert, you cannot win.
Kelly Saki.
Kelly Saki.
Kelly Sakai? Kelly? Kelly's not here. Okay. This is good.
Janice Duncan.
Janice, where are you, Janice? All right. Okay. Oh, we have one more, right? Is this it? One more. Okay, one last one. Thank you. Robert Levon? Is that, oh, there you are. Yay! Congratulations. Robert? Where's Robert? Right here. Perfect. Wonderful. Thank you so much, Robert. Thank you so much, Jacob. Appreciate it. Thank you. All right. Just make sure, hey, your valet parkings are covered. We already paid for your valet. No need to tip them. We are tipping them. If you are self-parked, we have the stickers for you. Millie, raise her hand. She has the sticker, so you don't get charged when you go out. We're covering your self-park as well as valet parking. Thank you so much for being our clients. Have a fantastic new year.